by my colleague Sophie Caesar. Lately, the markets have been very resource and tech focused. We thought it would be a nice change of pace to invite YSS to present. YSS is a publicly traded premier cannabis retailer and trusted destination for adult use cannabis in Canada. They trade on the TSX venture under the symbol YSS. They are focused on driving near-term growth while building long-term shareholder value. They currently have 17 operating stores and plan to continue expansion. Here to share their story with us is the CEO, THEO Zunich. Welcome, THEO. Feel free to start whenever you're ready, and we'll take questions after your presentation.
Okay, thanks, Paul.
You're welcome.
I'm going to share my screen and then I'll start presenting. Paul or Sophie, can you guys see the screen okay?
We can.
Yeah,
it's great to you.
Okay. All right. Hi, everyone. Thanks for taking the time to hear the YSS story. I'm just going to jump right into it. My understanding is there's going to be questions at the end. I'll do my best to answer them. Pretty quick presentation. So a little bit as an intro into YSS. As Paul mentioned, we're cannabis retail. We're a cannabis retail company. We're solely cannabis retail. We don't touch any of the upstream logistics or cultivation, and have no plans to. Why we like the cannabis space and why we all got involved as a company, as investors, in June 2018 when we did our first and only capital raise. We see cannabis as being the highest growth CPG category in Canada over the next 3 to 5 years. I think lots of people have talked about the unprecedented opportunity in cannabis, and it did drive a lot of hype. But I think a lot of the investors and a lot of the market thought it would come a lot quicker than it has. We like to look to Colorado as a proxy, and using some of the Colorado numbers, and I'll dig into them a little bit in a few slides, suggests 3 to 5 times growth from where we are currently. So, we've already seen growth over the last 18, 24 months in the cannabis sector, and there's going to be a lot more coming. So it's a great industry to be involved in. So why retail within cannabis? In our opinion, it's the lowest risk segment of the sector. If you think about all the supply shortages we had, and the idea of running a cultivation facility, it's not easy. It's highly capital intensive. You have high cost human resources. You have high risk around developing products and then executing on those products. Within retail, our business is simple, and a statement I've said in the past: it doesn't matter if it's widgets or weed. All we're doing is selling a consumer packaged end product. We get it sealed. If we're going to buy a product, we don't have to acquire a lot of inventory. We can always test a product first, and typically, worst case, we have to sell it at cost if it doesn't meet the demand. So, very low risk sector of the cannabis industry, which is probably the highest growth CPG category in the next 3 to 5 years. So then, why YSS? We've proven that we are a prudent management team and a capable management team. We've established 17 stores. We have 16 in Alberta and 1 in Saskatchewan. Q2, we ran at 4.7 million revenue, driving 359,000 store level EBITDA. I can talk a little bit more about the profitability later, and that'll make more sense. And then most importantly, we have 4.1 million cash in the bank at the end of June. No debt on the books. I think a lot of the peers in the space have used some of the debt capital to finance growth during this grow at all costs kind of cycle we went through 2018 and into 2019. We took a little bit more of a slow and steady approach, focus on quality over quantity, focus on maintaining fiscal prudence and clean balance sheet, and a clean capital structure. And we'll talk about that a little bit later. So high risk sector, low risk segment of a sector, and well-established, financially sound company. So a little bit about cannabis growth. We love to look at Colorado as a proxy because it's in its 7th year since it legalized cannabis. It's on pace this year to exceed 1.5 billion in recreational cannabis sales. So that works out to about 268,000 per capita, or sorry, $268 per capita. Comparing that to Canada, Canada's on pace to do 2 billion or $56 per capita. So that's where you can see you have 5 times growth across Canada if you use Colorado as a proxy. So in 5 years, you could arguably state that Canada should be a $10 billion market from 2 billion this year. Alberta, where the core of our current operations is, I've heard people tell me in the past that they think Alberta's saturated. It's by no means saturated, and there's more growth to come. We're on pace to do about 480 million in Alberta in retail sales this year. That's 111 per capita. We're still a far cry from the 268 in Colorado, and Colorado would imply a $1.1 billion market in Canada or in Alberta. So if you look at the chart, the other encouraging factor that we see out of Colorado is it's still growing. 7 years later, it did 1.4 last year. It's doing 1.5 this year. So the market size continues to grow even 7 years. So in our case, 5 years from now into the future. Talked a little bit about why cannabis retail in the intro. We're the end of the supply chain. So it's trading of finished goods that are pre-sealed. We have no exposure to crop failures, packaging, logistic challenges, limited exposure to a product that may come into our store and doesn't get any demand. Bonuses are geographically and demographically diverse assets. We saw a little bit of that during COVID. We have a downtown Calgary location that has struggled as the traffic downtown has left. But contrary to that, some of our grocery anchored community stores have seen significant growth through the COVID experience. So again, it's statistical diversity, low risk, low capital exposure. We're about 275 to 340 in capital costs per store. If you compare that versus a cultivation facility, you can see why low capital intensity. We showed a lot of resiliency as an essential service and allowable business in the COVID-19 pandemic. And as a sin industry, liquor, lottery, tobacco typically do well in economic downturns as well as economic upturns. So feel like it's a low risk segment, as I mentioned. Then the big bonus is direct access to consumers. That's something that's really transitioning now. We see a lot of the licensed producers struggling with sell-through, which is, they can produce all they want, but they're not getting the demand. As the retail side of the industry, we totally control that. There's limited marketing avenues for brands and licensed producers to try to talk about their products outside of our stores. So we have control of the messaging. We have direct access to consumers, and we follow consumer-related data. And it's becoming increasingly more important, and the licensed producers are recognizing that. So strategic value within the cannabis retail segment of the sector. A little bit about our team. I'm an investment banker by background. I transitioned out of a lot of oil and gas about 5-6 years ago, and was a co-founding partner of A Capital. Through that role, I became involved in the cannabis sector all the way back to when Bedrocan and Tweed merged to become Canopy. So I've been involved in the sector for a long time, investment banking by background. Stephanie Bunch, our VP Finance CFO, 25 plus years of industry experience, CFO roles at multiple public companies. You won't see us miss any quarter deadlines and everything. Feel free to review our financials. She's an incredible resource for the company and very experienced. Tony Blackus, our VP of Operations. He comes from Sweet Tree, and you'll see in a moment we have 2 retail brands. Tony and his brother founded Sweet Tree in 2017, and then opened a few stores in Calgary, had a few more stores in the hopper. And in mid 2019, when we were still not very operational, we had one store in operation. We went out and we found the Sweet Tree acquisition as a very strategically aligned acquisition. So not only did it bring more stores built awaiting inspection, but it brought a team of operational experience. And so Tony and his brother come from a background of restaurants and hospitality. They've been doing it for 20 years. They run 3 successful restaurants in Calgary. And what that brought was something that Stephanie and I don't really have experience in, it's retail operations, hospitality, and customer service. So it's been an outstanding addition. Tony's our largest shareholder and a huge member of the team. I encourage you to check out some of our Google reviews, and you can see, the aspect that Tony brings to the table. Board of directors, lots of corporate governance, public market experience with Rick McCarty from the Spartan family of oil companies. Ron Hodgson was formerly the CFO of Tamarack Valley. I think it peaked at $2 billion in the public market. Now VP Finance, CFO of a private company, but 20 years of public market experience. And then James Miller, prior to running his own real estate portfolio, was with Avis & Young and brings a real estate background to our board. So well-rounded, high corporate governance, and strategically aligned with 15% basic and 20% fully diluted ownership. I should also mention that everybody in the company is invested at 30 cents equivalent shares. We had no cheap paper when we went out and raised our capital in 2018. A little bit about our retail strategy. The bottom line here is you need location. Location's everything. You can focus on other points in retail to win the day, but if you don't have location, everything else could be a moot point. So that's really what drives us. I don't need to touch too much on this, but you're looking for proximate traffic drivers. So grocery anchor, Tim Hortons, Shoppers Drug Mart, restaurants, liquor stores, pizza joints. We have multiple stores that it's a pizza place, a cannabis shop, and a liquor store. Those are the kind of things that you really need with parking in front to drive natural traffic and store success. Retail brands, so YSS Cannabis, as well as the family or the parent company, YSS Corp, is our core brand. It's all rooted in discovery and exploration, inspired by things you'd see in travel. The idea here is experienced cannabis consumers are going to be looking for convenience and price and selection. How do you cater to the rest of the market, being curious and nervous cannabis consumers? The last thing they're going to want to see is a cannabis leaf in your face and that traditional cannabis culture in a store. So we designed our store kind of inspired by airport lounges and train stations. So you're going to see maps, you're going to see primary colors, dotted lines, arrows. Even the name YSS is a play on all the airports in Canada. It's the only country in the world that starts with Y, 3-letter abbreviation or 3-letter identifiers for the airports. Of course, done as YSS, but we're YSS. Sweet Tree Cannabis was that acquisition I mentioned in June 2019, where Tony came on as our VP operations. Again, doesn't go with kind of the in-your-face traditional canna green style of that old school traditional cannabis consumer, but it does play it a little bit more with some darker colors, and but it's got a very strong customer following in Calgary and Southern Alberta. So in the future, we will use both brands selectively, but YSS Cannabis will be our core brand. Retail operations, this just summarizes where we are. 10 YSS stores spread across Alberta, 7 Sweet Tree Cannabis stores, mostly in Calgary, with Okotoks, High River, and Swift Current, Saskatchewan. And then in the future, what we're up to right now. So we're at 17 stores today. We are going to be completing the Hamptons in Edmonton. People, I mentioned earlier, I've heard that Alberta is a saturated market for retail cannabis stores because there's 500 stores now in the province. I think what a lot of people miss is there are pockets of stores, and you'll see it happening in Toronto already with Ontario changing the rules. A lot of people build stores without understanding the competitive landscape within that area. So an example I typically use is McLeod Trail in Calgary has 10 stores on a 10-kilometer stretch. That area is definitely oversaturated. But we've been able to identify some real estate opportunities in Alberta still where there's no competition. So Edmonton, Hamptons is one. It's in southwest Edmonton. There's no stores within a 7-kilometer radius. So in a residential area. So you have that convenience factor, you have nearby shopping, and it's indicative of what we look for in a new location. Calgary Country Hills, we're going to be breaking ground in the next 2 weeks. Hope to get that one up and open in November. Again, no stores within a 6-kilometer radius. Really love that location. And then we're beginning our expansion into Ontario. Similar to our strategy in Alberta, we didn't go hard out of the gate into Ontario. Some of the peers are. Our view is that an unbuilt location is a liability until it's open. And the licensing regime within Ontario has made it risky to advance projects and advance capital there with uncertainty around timeline to licensing. So we are slowly getting into it. We're starting the AGCO, the regulator in Ontario, announced the increase in number of stores, new licenses last week. So they're bringing it from 20 a month to 40 a month. So great indicator that more licenses are coming, and a good indicator for us that now is the time to start spending some more time focused in Ontario. So we are starting that Waterloo store in the next couple weeks. We'll get it built and inspected as quick as we can, and we're expecting that 6 to 12 month delay on licensing with the potential that gets accelerated. We're about to sign a lease in a second location in Ontario, and then we've got a list of another 10 that we shortlisted from about 150 that we're going to pursue to keep the growth going into 2021 and beyond. So near term, 17 stores going to 19 in Alberta, potentially more Alberta into 2021, but more focusing on Ontario. But the timeline to open is kind of around, it's going to be based on AGCO, Ontario regulator licensing. A little bit about our sales growth and our profitability. Coming into 2019, there's a lot of volatility in the sector. We hadn't seen Cannabis 2.0 products coming to market yet, so that's the vape products, edibles, beverages, some of the extracts. So we knew that the market was due for some growth. We just didn't understand. Can't really predict how quickly it's going to grow. We know it's going to be, $1 billion in Alberta in 5 years, but what's the next 6 months look like? And what we found out was the growth with those new products and improving flower product selection came quick into 2020 and has continued throughout the year. So you can see we're up 51% in revenue, July over January. That's with adding only one new store. So it's predominantly growth from existing stores. And that's important because of the fixed cost nature of retail. Labor, you can only cut so much. Your rent and your associated operating costs, they're all very fixed on a month-to-month basis. So when we see revenue growth on a same store basis like this, it drives significant, exponential EBITDA growth. So over the same period of time, 51% revenue translated to over 1,000% EBITDA growth. We're seeing these trends continue. August kind of flatlined into July, and then we're seeing growth into early September again. We could see some seasonality into the fall, but I think these are just all indicative of the market growth that we're seeing, as well as some indications that we're capturing more market share from both the black market as well as other competitors. Another key point here is we talk in some of our press releases about exiting the year in an EBITDA positive run rate position. We believe we can do that on the 17 stores we currently have. We run at about 220 to 230 a month in G&A. And if you see the blue line at the bottom of the chart here, we're just shy of 250 in store level EBITDA in July. So store level EBITDA is how much EBITDA the stores are spitting off against our G&A, gets you to what our corporate EBITDA should be. And that's how we believe we're going to be at an EBITDA profitable position in the next few months. Operational efficiencies. Revenue growth is obviously important, but operational efficiency is equally as important. A lot of the stats are driven by both cost cutting and revenue growth, but the outcomes are key. Our store level EBITDA has improved from 4% to 8%, and now it's north of 10% in the last couple months. We've cut operating costs to less than $30,000 a store. So our break even on an average store is about $100,000 of revenue per month, or 1.2 million per year. At our current run rate, we're well above that. So we have 15, soon to be 16 stores in an EBITDA profitable position, contributing to the corporate EBITDA. G&A expenses, we've been doing our best to keep them coming down despite the growth. We've knocked off 150,000 Q2 over Q1, and feel like 670 a quarter, around 2.8 to 3 million a year is the sweet spot for us. It's going to be hard to squeeze it any tighter than that. But the important thing about the G&A is, because we're an operating company that's already pretty much covering our G&A expenses, all the growth from here on out goes straight to the bottom line. We don't really need more than maybe a new accountant and maybe a new operations manager to add 10 stores. So the growth that we're going to see is, again, exponential to profitability. And that's really what the next 6 months are going to be like. Great revenue growth, but even better EBITDA growth. Tying to the operational efficiencies or capital efficiencies, we've cut our store build cost from $518,000 down to $275,000 on the 2 stores that we're kind of under construction right now. And all indications are we're going to hit those targets. So that's really where we're going to be going forward. We're getting to the point where we're going to start losing some quality if we cut too much lower than 275. There's the opportunity to do some micro style stores, maybe for 150 to 200, but those will be kind of one-off cases. But the important thing is, with the revenue that we've seen, our operational efficiencies we've delivered, as well as the capital efficiencies we've delivered, we started tracking what the store economics look like. And there's just not enough data really to put it into a corporate presentation yet. But based on recent results out of the stores, actual results, and the capital efficiencies we're currently hitting, the IRR on a new build kind of ranges in that 80 to 250% range, depending if the store is Alberta, Saskatchewan, or Ontario. So in any industry, those kind of economics look great and really can drive a company into significant growth. So that's where our focus is now. We've got the cash on our balance sheet. We've got the established business. We know what the economics look like. now is the time to get after it and accelerate growth into the next 6 to 12 months. Corporate summary, pretty clean capital structure. As I mentioned, all our money has been raised at 30 cents. That ties to those performance and advisory warrants where board management received a warrant for every share they invested. So we paid up front for our performance and advisory warrants, and they're all at 30-cent exercise. So pretty clean capital structure. As I mentioned, cash of 4.1 at the end of June. We do have a little bit of those COVID-19 loans, so I guess I can't say debt-free anymore. We have 160,000 in loans that are long-term. But all said and done, we're running at 12.5 cents. So today we're trading at 14. We're about a $15 million enterprise value. Implies about, on trailing revenue, implies about a 0.7 to 0.75 times trailing revenue. So the opportunity, as I mentioned, early days in the high growth CPG category of cannabis. We expect 3 to 5 times growth from here in Alberta and across Canada. Retail is a great way to play the cannabis sector. It's low risk with the added benefit of having access to the consumer and having access to consumer data. We're a proven established retailer with 17 stores, a lean capital structure, and a fiscally prudent management team. We're going to continue building off what we've already established and accelerate growth over the next 6 to 12 months. And then we have financial flexibility, clean balance sheet, 4.1 million cash in the bank at the end of June. And so we have enough money to do everything we've got planned. That's the presentation. I can open it up to questions.
Great. So we do have a couple of questions. Thank you so much, Theo, for your presentation. I know you touched on your plans to open in Ontario, but do you have any other provinces in mind? And if you could touch on that, please.
Yeah, and I could do a little bit of a breakdown. We've stayed tight on BC, but the fact is the BC government has yet to issue a license to a non-resident retailer, private or as a company. And our belief and our understanding is it ties to the government, the NDP government's focus on, I guess, keeping business inside the province. Coupled on that, the black market is still rampant in BC. So we see BC as very risky with not enough reward to justify jumping into. I mentioned Alberta, we do have some good growth opportunities there. Saskatchewan, what's changed in the last little while is they started with a lottery of 50 stores across the province. As of September 1, a week ago, the market is now a regulatory open market. So we are evaluating, we've got 2 locations identified in Saskatoon and 1 in Regina. To add to that, Saskatchewan will be part of that next 6 to 12 months growth because it's an underserved market still that just opened. So we like the opportunities in Regina and Saskatoon. Principally, those are the big cities within the province. And then Ontario is really the only other market other than Newfoundland that is, Manitoba is already very, I guess, not saturated, but very competitive. Really, if you don't have Winnipeg, there's not a lot of the great great towns to focus on. That really leaves Ontario as the other focus. And Ontario's, of course, the next 3 to 5 years of growth will be focusing challenge still, as I kind of mentioned.
Yes.
So I think for us, the growth will be a little bit Alberta, a little bit of Saskatchewan, and then a lot of Ontario in the next 1 to 2 years.
Okay, thank you. As well, you mentioned your COVID loans, but how else has COVID affected your operations?
It was definitely a challenge when we were made an essential and allowable service allowable in Saskatchewan, essential in Alberta, in that it kind of forced you to stay open whether you wanted to or not. And we wanted to, of course, but we were very, we're also, at that point in time, the amount of data on COVID was very different. It was March. And employee and customer safety was obviously front of mind. So, we took it upon ourselves and tried to make it as safe and as comfortable for everybody in our company, as well as the customers. We took a lot of safety measures. We put up plexiglass barriers, cleaning measures, distancing measures. We really did a lot. With that, we also told employees, and they're hourly employees, so it wasn't hurting our bottom line, but take time off if you don't want to come to store. And that was the biggest challenge. We had about 30% of our staff decide to go home, self-isolate, play it safe. And as a result, we had to cut some hours, but all retail was doing that at the same time. So the entire shopping centers we were in had shortened hours, but we didn't see a decrease in sales. People seemed to buy more when they came. Sales continued right through March. We saw a peak when COVID first hit in late March, pantry loading. April kind of came down a little bit, but then May, when people started getting comfortable with everything and we started getting our employees back, we were able to start moving back to our regular hours, and revenue growth kind of just stayed steady throughout. So it was a human resources challenge mostly for us.
Yeah. It also must have given you guys a leg up to prepare before everyone else.
Yeah. We, now, as things are changing, we've already got everything in place. We don't really talk about it much anymore because it's all there. We just remind everybody, be safe.
Perfect. This is a question. You really didn't discuss product quality versus the competition. Is there a UPA versus other retailers?
Yeah, I think, I'm guessing that question, please feel free to type in if I missed it. That question's around our inventory versus other, what we sell versus other retailers and how we have a competitive advantage in that. In Alberta, where we predominantly, our operations are our 16 stores, you buy from the government. It's the same situation in Ontario. All retailers, regardless of size, regardless of scale and relationships, all have the same price, same availability as everybody else. And the government acts as a kind of a mitigating wholesaler, which is incredibly helpful because they basically wholesale for us and deliver to our door for no added cost. So it's convenient, but in that we can't really create a competitive advantage by negotiating scalable contracts with different suppliers. But what we have done really well, identifying a way to find a competitive advantage in that, our inventory turnover is incredibly tight. We're down to about 2.2 weeks cannabis inventory on hand. We get weekly deliveries. It's the biggest focus for us because it keeps cash in our jeans versus locked in inventory.
Yeah.
But what's happened within the cannabis supply is every week new products are coming to market and other products are decreasing their wholesale price. So it's incredibly dynamic, and by having a very tight inventory turnover, we're becoming known in Alberta as having the freshest products, the newest products with the best prices. Even though our margin is the same as everybody else, we just bought it cheaper. So we found a way to create a competitive advantage by using our cash balance to support that and focusing on the data. But there's no advantage. You can't really negotiate with an LP a better price. In Saskatchewan, you can, which we've started to do. And we have an even better selection in our Saskatchewan store by virtue of being allowed to buy directly from LPs.
And would you say the in-store experience, could that work as well as your competitive advantage? Because you talked a little bit about, the feel and look of the store. Yeah,
I think we definitely, like I said, your traditional cannabis consumer is going to be convenience, price, selection. We've got very loyal customers within that group. We have a loyalty program that gets a lot of buzz. We always try to keep some good things on sale, kind of like Canadian Tire. You walk in, there's always something for everybody on sale. And now with the new product types that are coming to market, the beverages, wider selection, we have topical creams now. That's where I think we are starting to capture a little bit more of that market growth, those kind of curious, kind of nervous people that I kind of mentioned. They do like to come to our store because of the feel of it. Our staff are all highly trained. We have our own internal academy that, when you become a cannabis worker, it's qualified cannabis workers, what they call it in Alberta. They drive a lot of the regulatory stuff down your throat when you're going through the training process. We decided we need something else. You can't make cannabis. You got to fight the stigma a little bit.
Yeah.
And so we designed our own. We call it the YSS Academy. All our employees are trained on it. It's about a 5-hour program with testing, and it touches on the lighter style. So the history of cannabis, the endocannabinoid system, forms of consumption. And I think just putting that extra training in the hands of our staff makes them more confident and comfortable talking about those new product types with people that may be nervous about cannabis. So we are doing everything we can on the retail experience side. And some of the stats we follow are suggesting that we are punching above our weight in terms of market share.
Great. There's a couple of questions here that came up regarding online sales and e-commerce. Is that, I don't believe that's something that you have. Is that something that you would be considering going forward? Are you planning for it?
Yeah, so in Alberta, we're not allowed to sell online. The transaction has to happen in store. So we do have a click and collect program that we launched in April. It's been incredibly successful. We're up to about 12 or 13% of all sales essentially online. So they go online, they shop online, they fill their basket, they submit the basket, but you have to pay in store. So when you go pick it up, you tap your card, you walk out. So it's almost e-commerce, but because of the regulation, we're not allowed yet. In Saskatchewan, we are allowed e-commerce and delivery. At this point, we are just transitioning the click and collect to e-commerce so that we're ahead of the game in case Alberta allows e-commerce. So we're essentially there. It's just a matter of turning it on. And what's happened is BC has just allowed e-commerce a few weeks ago. So it could happen in Alberta. We expect e-commerce to probably be allowed in Alberta. Delivery is a different beast.
Yeah.
So the regulations around what you could do if you have to have your own employee deliver versus a third party makes it potentially very difficult and costly. So for now, we're essentially ready to go if any changes come, and click and collect has been successful for us, but the regulations restrict us from full e-commerce.
Excellent. So we're running out of time, even though we have tons of questions, but maybe we can revisit them with you in an interview later on. But I'm sure Paul just came on. He probably has 1 or 2 questions for you.
Yeah, I mean, Theo, you don't grow your own product, right?
Nope.
So, I mean, do you look for specific strains, or I mean, are you just looking for what's hot out there, what people are buying? Obviously, higher percentage, it sells quicker than lower percentage, things like that. And do you brand anything? I mean, with the edible market that started in January, but with COVID messing a lot of things up, are you selling edibles, vape pens, drinks, anything of that nature right now?
Yeah. So I think probably 3 questions there. Product quality when it comes to dried flower and pre-rolls, which is the longest standing product selection we've had.
Yep.
We're on top of it. We're talking to the LPs all the time. They want sell-through, so they're happy to give us information. And it goes back to the data. We're following the data. We're trying to stay ahead of different crops will have different THCs, so we try to get the information before everybody else, and it affects how we buy. Further to that, most of our ops team and myself included, we do love cannabis, and we try a lot of the products before we dare put them on the shelf, especially if it's an LP we don't know or we don't trust. So we'll go to a different store and try it there first, or we'll buy 1 case at our store, and if it's good, we'll buy more. We're very careful about it, but we're incredibly knowledgeable about the products that are out there. So we've got a good sense on finger on the pulse about what's selling and what's not. 2.0 products, they started hitting the market in February, but not in big quantities and 2.0 is your beverages, edibles, chocolates, gummies, the vape pens, the extracts, the topicals, really anything other than flower. And hit the markets in February in Alberta, but really inventory didn't really get to the shelves till April, May, and it still continues to grow every week. But a big part of the growth we've seen this year is attributable to those products. Flower's kind of sitting steady for us on our category sales. Pre-rolls is kind of bounces around a little bit, but all the growth we're seeing is really out of those other product lines. And when I say flower's staying steady, that was the big thing we were worried about is do these other products cannibalize some of the current flower sales? And what we're finding is no, they don't.
I don't think so. No, I agree.
Yeah, and the other beautiful thing is our basket size, which is how, the dollar per customer per transaction has been steady for really the last 12 to 15 months, despite the fact that wholesale and retail prices have come down as much as 30, 50, 60%. So when people are coming to the store, they're actually just buying more every transaction. So some great statistical indicators there. I think that answered 2 of your questions. I might have missed one.
No, you're good. I have one other question. With the U.S. elections coming soon in November, the Democrats having a chance to win, and they would probably, under their mandate, they would nationalize and deregulate marijuana like on a federal level. What impact would that have on you in Canada, basically based out of Alberta?
Interesting question. I think if anything, it could open up a lot more acquirers of us.
That's the point I was getting at.
Yeah, I think there are U.S. operators, and really the U.S. Integrated operators have knocked out some great numbers recently. I think if anybody follows it, you'll know that they're beating estimates and actually increasing guidance, which is a bit of an anomaly in the space thus far. And I do think that that's what the possibility is. The other thing it does is it opens up us moving into a state. And I say a state because the U.S. regulations are so state by state.
Yep.
I wouldn't look at the U.S. as an opportunity to expand, but maybe a specific state we would look at. Something that kind of fits a similar regulatory framework that we're currently dealing with. So it could go both ways.
Yep. And would you do something potentially down the road that Planet 13 is doing in Vegas and have like a superstore where you have everything there, one-stop shopping, you've got your, due to regulations or whatever, but is Canada ever going to loosen up enough for you to do something like that?
I think we probably would look at doing a consumption lounge with a store if that ever allowed us.
Yeah.
I don't think we're ever going to want to do the big superstore where people have to drive out of their way to get to the store. Our business model is based on operational efficiencies. We love 1,200 to 1,400 square foot stores with low rent, perfect size footprint. It's a small product. That's the beautiful thing over like liquor sales. It doesn't take up very much room. So you can make incredibly efficient stores in very convenient locations and capture that extra 1 or 2% margin versus doing like the big expensive store. There's a lot of risk in building that kind of store.
Yes.
Especially if there's 2 stores that open up next to it. You can't prevent that.
Yeah.
So no, I think we're going to stick to our business model of, small, convenient, operationally efficient locations. And you had mentioned about white labeling. That was the other question you said.
Yes,
about
that's
yeah.
exactly.
We're never going to grow our own, but there's ways to contract, and we're actually coming to market with Sweet Treat Kush in October.
Okay, I got you. That's
Already underway.
You want to have a signature product or something like that to kind of brand yourself. One last question, we'll wrap it up. I mean, Sophie and I are going to follow you for the next 4 months, all your press releases, all your news and that there. I've already talked to a bunch of my trading buddies about your company, so it's all good there. One last question. Have you looked at, or would you move to the US, like through acquisition or, just to try and get some foothold down there, You just
Yeah, and I think it ties to your point. I think if legalization happened, and even if it didn't, we would consider it. We have looked at acquisitions.
okay.
It would have to be a specific state that we would go after, because the regulations are so varying between state by state. At this point, we felt that the provinces in Canada, and now when we look ahead, it's Saskatchewan and Ontario, we see some near-term growth, is more than enough opportunity for us to do what we're currently doing and spend the money we have in the balance sheet. And it doesn't really muddy the story. We're trying to stay focused, stay efficient. If you go to a state, a lot of the efficiency really gets muddied. And we know being an efficient operator is going to be key to long-term value.
Agreed. Theo, thank you so much for today. Much appreciated. YSS is a great story. They're very well set up in Alberta. It's one of the best operations that are out there. A lot of Canadian cannabis companies are struggling, but you guys certainly are not. So kudos to you guys. We'll follow you for the next 4 months. Thanks to everyone for joining in today. Much appreciated. And Theo, we'll talk soon.
Thanks a lot, everybody. Have a great day.
Thanks so much. Appreciate it.